This is a video on internal controls over the sales receivable and cash receipts transaction cycles. Typically on the CPA exam, if there is a question regarding internal controls relative to a particular transaction cycle, there's a high likelihood it's going to be on the sales receivables and cash receipts cycle. So let's go over that cycle right now, and let's take a look at the cycle from what I call the 10,000 foot level. Now, if we take a look at the beginning of the transaction cycle, we just don't sell something or we just don't ship something to somebody. What we have to do is first we have to receive a customer purchase order, some type of customer contract saying that they want to purchase the goods. And we're going to assume right now I'm saying goods, meaning that they want to purchase some form of inventory. It could be services or other items of value, but for our purposes right now, just to make life a little bit easier and simpler, we're going to assume that we're selling them some form of inventory. So the customer receives, or the customer, we receive a purchase order or a contract from the customer regarding a particular purchase. What's going to happen then is that purchase will be sent on to our credit department, and the credit department is going to review the customer's credit worthiness. Is the customer willing and able to pay for this inventory that we're sending to them? Because we're sending them the actual physical inventory, so we should reasonably expect payment from the customer before we send it to them, or after we send it to them, sorry. Now, the next thing after we obtain credit approval, we're going to then prepare the shipping and packing documents. In other words, where the inventory is being shipped to, and then packing documents that also go along in the shipping, the shipping, the shipment itself. After that, then we're going to ship those goods out of our shipping department, and we're going to verify that shipment of goods basically by sending notification to our billing department. The billing department, upon notification of the shipment, then will prepare the invoice to be sent to the customer, and that invoice then will be sent to the customer, and the customer then will hopefully pay that invoice or a series of invoices, and that's where we show received payment. Now, I've skipped one box here, and this is a box that occurs typically on either a monthly basis or a quarterly basis, or whatever periodic basis the company wants to notify their customers. But what we'll do is we will send a statement to the customer listing all of their invoice transactions and all of their payments, which then the customer can verify against their records and understand or ensure that those records are correct. So that becomes an important part of our control system, because our customer is going to provide a check on what we're doing. Now we're going to go on to document flowcharts, and these document flowcharts can look kind of complex. And the thing that these document flowcharts do is they depict the flow of documents, and also they can depict the flow of controls in this case, the sales receivables and cash receipts process. Now, what's important to note here is that this is not a this is an example of a document flowchart for sales receivables and cash receipts. If for 100 different flowcharts, for 100 different people, there's 100 different ways of creating these document flowcharts. So not every document flowchart is the same. It may depict similar flows, but don't feel that just because this document flowchart shows as a certain way means that this is the only right way of doing it. There's many, many, many ways. So this is simply an illustration. So let's go back up to the top of the beginning of the sales receivables cash receipts process. And what we see here again is we see the sales process begins with the receipt of a customer order, and that could be a purchase order, it could be a contract, It could be an email, which would form a customer contract or whatever. And the customer is going to indicate what they want, what type of inventory they want to buy, and the quantity. And typically, they're also going to put in an agreed to price regarding the merchandise desired. Now, the company sales department's going to receive that purchase order. And upon that, then the company sales department is going to create what we call a sales order. And that sales order now represents the purchase, the customer's request to purchase inventory. Now, the sales department in the sales order is going to capture vital information, such as obviously the customer's name, the customer's address, the customer's account number, the name, number, and the description of the items that are being, I say items sold that are being purchased from the company, also the quantities purchased and the agreed to unit prices. Now, what that means also is when the sales department is performing this function, the sales department ensures the order pricing and terms conform to the authorized prices and terms for that particular customer. Remember, most pricing is a negotiated process, so not everybody is necessarily going to be paying the same pricing. So we have to make sure that the sales department concurs that the pricing and the terms that the customer says that they're entitled to are the terms that the customer, or basically that the company, has agreed to. Now, the sales order, when it's created, it documents a number of different things, and we can look at it as being a number of main copies here. Now, actually, when I say stock release or packing slip or so forth, there may be more than one copy. These just represent, these four items here represent the main components of the sales order. And so there'll be a sales order, there'll be a copy of the stock release, as a matter of fact, several copies of that. There'll be a copy of the packing slip and a copy or several copies of the shipping notice. And what these items are is the sales order, basically the other items are duplicates of what's written on the sales order, because all that information is going to be necessary to do stock releases, to inform the customer on the packing slip, and also do shipping. Now, the other thing is that the sales order and all its copies, the documents here, are all pre-numbered. And that's a very important control, because if everything is pre-numbered, that helps ensure all of these documents can be accounted for during the revenue and receivables process. So if I'm the shipping department and I'm accounting for the sequential number of my shipping orders and I see a couple of those numbers missing, I know that I have a couple of shipments that may be missing. Or if I'm in the accounting department and I'm accounting for the sequence of the shipping notices and I find a shipping notice is missing, I need to look for that because for some reason it's missing. So pre-numbering documents is a really important control process. Now, before processing the order any further, after the sales order is created, the customer's creditworthiness needs to be established. So in order for the order to move forward, the credit department needs to be able to approve the order. And of course, that ensures that we're going to have a high probability regarding the collectability of the receivables, because when you think about it, we're releasing assets to a customer and we want to receive an asset in the form of a payment in return. Now, what I'm going to do is show you a little bit of how these forms are distributed. And once a credit department releases this, these orders and these forms become releases. The release from credit initiates the order fulfillment process. A copy of the sales order will go to the billing department, and that'll be used as a basis for creating an invoice. Stock releases will go to the warehouse where the inventory is maintained, and also inventory control, which is a department that keeps the detailed inventory records. The packing slip then, again, as a copy of the sales order will go to the shipping department along with at least one copy and possibly two copies of the shipping notice. So now let's take a look at what happens as we follow these documents through the process. Okay, now we can take a look at, and I'm calling this, I said there'd be two copies of the stock release. So this is stock release copy 1 and this is stock release copy 2. So let's see what happens with stock release copy 1. The stock release goes to the inventory control department. The inventory control department then will use that stock release to update their detailed inventory records, meaning that the products that are going to be taken out of the inventory warehouse are going to be are the items on that stock release form. Now, what I'm saying here is inventory control updates inventory records and basically the journal entry to relieve inventory and charge cost of goods sold for the inventory being removed from the accounts. Now, note here that inventory control has no access to the actual inventory. So the only thing inventory control does is keep the records. The people with access to the inventory have access to the inventory, but it's not their job to keep the detailed inventory records. And you can see right there that constitutes a control, because now I do not violate the segregation of duties of having custody over the inventory and recording authority over the inventory, because if I had both of those, I could basically conceal some form of fictitious transaction, or I could conceal some type of defalcation. Inventory control accounts for the sequential order of the stock release forms to ensure that all those stock release forms have been processed. If we're missing stock release forms out of the sequence, that means we got to go back and find them, because those items for some reason are missing and we need to find out where they are so they can be recorded or otherwise accounted for. Now we go on to stock release number 2. Stock release number 2 goes to the warehouse itself where the inventory is kept. The warehouse will pick the goods to be shipped, and it's going to forward those goods to shipping. And the way the warehouse knows to do that is through the authorization of the stock release form. And then they know they send that on to shipping. Now, at the same time, the stock release form, or the actual inventory itself, gets sent to the shipping department. So I'm going to draw a red arrow there. Whoops. Sorry about that. I managed to skip one moment while I stopped my presentation. Okay, I'm back to the presentation. And what I wanted to do is depict the fact that the physical inventory itself was being moved over to the shipping department. Now, I also mentioned earlier that the packing slip and the shipping notice, which is the authorization to ship, gets sent to the shipping department. So the shipping department knows exactly what they're shipping and who they're shipping that to. So when they receive the inventory from the warehouse, they can start the shipping function. So the shipping in effect checks the shipping notice against the goods received from the warehouse to make sure they have the right goods and they're going to be sending out the right stuff. The shipping department also will prepare at the shipping department level a bill of lading for the shipper, and then we'll ship the goods. Now, a bill of lading is a legal document that gives a common carrier the right to ship goods. So that's all you need to know about that at this point in time. So that's what the bill of lading is. Now, upon shipment, the shipping department enters in the shipping department log and enters that shipment in the shipping department log and files a copy of the shipping, in effect, the shipping notice within the shipping department. We see the shipping log here. Now, again, the shipping department accounts for the sequential order of all the stock releases to ensure all those stock releases have been processed. You'll notice here I depict then, here's the inventory goods being sent along with the packing slip and the bill of lading on the common carrier out to the customer. Now what will happen is that the shipping department will send then the shipping notice and a copy of the shipping report onto the billing department. We should pick that up on the next slide. Okay, again, I say up here, I start off with the term credit department, but this is the sales order. If you remember on that first slide, I said that the credit department was going to send a copy of the sales order to the billing department, and that's what this is depicted right here. The credit department is sending that sales order onto the billing department, and I depicted that in the first flow chart. The shipping department also then, as I mentioned from the previous slide, sends a copy of the shipping notice, basically the shipping report and the stock release to the billing department. Now, what that means is now the billing department is going to have the information, the correct information to bill the customer in terms of pricing terms and the customer itself. And then the billing department is also going to have verification that the actual amount of items were shipped to the customer. So these two documents are matched up, and then the billing department is going to create a bill. Now, or an invoice rather. Now, billing will account for the sequential order of all of the shipping documents to ensure all authorized shipments are processed. In other words, anytime we see a shipping document, it should show that it's been shipped to a customer, and billing then can create an invoice from that. And as I mentioned here in this section, pricing and terms will be invoiced to the customer based upon the sales order and the confirmation of the shipment through the shipping order. And that's what I mentioned right here again. Billing creates the invoice based upon shipping items and sales order prices, terms, and enters the invoice data into the sales journal. So an invoice is created, and also an entry is put into the sales journal recording the sales. And the sale will be debit to accounts receivable and a credit to sales. Now, a copy of the invoice also then is going to be sent to the customer, and another copy of the invoice is going to be sent on to the accounts receivable department, who then are going to post that individual invoice to the accounts receivable subsidiary ledger. And again, the invoice documents are pre-numbered, meaning that we have control over and accounting for each document. And accounts receivable then will account for the sequential order of all the invoices to ensure that all authorized invoices are processed. And obviously this also helps protect us against fictitious entries, because we're not going to make an entry without a pre-numbered document authorizing that entry. Now let's kind of do a 10,000 foot level summary of the internal controls we've just been talking about. Now, in terms of internal controls activities, remember that the functions of duties of a sales transaction involves authorization, recording, custody of assets, and reconciliation. And that takes us back to the CARR: custody, authorization, recording, and reconciliation. Routing the sales order through credit ensures goods and services are shipped to customers who are creditworthy. Routing the stock transfer form, which is a copy of our sales order, we talked about that before, through the warehouse ensures goods are released only upon the receipt of an approved, in effect, sales order in the form of a stock transfer. Routing the shipping order, which is a copy of the sales order, through the shipping department ensures only authorized shipments are going to be shipped, because the shipping department will not ship anything other than what is being authorized through the shipping order, which is a copy of that sales order. Copies of the sales order and the shipping order are routed to billing, and that helps ensure inventory items shipped are invoiced at the correct pricing and terms because we match the sales order information up along with the shipping order information. Again, very importantly, pre-numbered documents are accounted for at every different or at every different level and reconciled to permit the detection of any unrecorded or any unauthorized transactions or any detection of any unrecorded or any unauthorized transactions. So pre-numbered documents are a critical part of the process. Now, I also mentioned too, obviously in a computerized system, the items don't have to be pre-numbered because they can be tracked individually through the system. But we're just talking about the concept of a manual system here. Also, something very, very important: periodic reconciliation of the accounts receivable subsidiary ledger, which are all the detailed postings to the individual customer accounts, to the general ledger. In other words, the accounts receivable control account can ensure all invoices and payments, if you will, or any other transactions against customer accounts are recorded in the customer's account. Now, it doesn't mean that they're recorded accurately in the correct customer's account, but they have been recorded somewhere in somebody's account. Okay, let's go on now and take a look at we've kind of looked at the sales receivables transaction cycle. We're going to take a look at one slide on cash receipts, internal control over our cash receipts. Cash receipts typically come from the customer, and they're going to come, at least traditionally, in the form of a physical check in the mail, and typically the check has a remittance advice. Now, remittance advice will say, we're paying you $1,000, and that's the amount of the check, and it will say in payment of invoice number 5, 7, and 8. So what happens is, using the remittance advice, then our client or our company now can go ahead and trace those payments back to the individual invoices in the customer subsidiary records. Typically, the mailroom then opens the mail and lists these checks. It also, what we call, restrictively endorses the checks and forwards the checks and remittance advices to the cashier of the company. Now, mailed checks are normally opened in the presence of two employees. In other words, one employee provides a check on another employee. Each check is restrictively endorsed, and what that means is that, again, if you haven't had a bit or you can't remember from your business law courses, is that there's a concept in business law that you can restrictively endorse a check to be deposited in a particular account. And typically there would be a restrictive endorse stamp that the employees would stamp on the check that says this check is for deposit only to Acme account number 123456. So what happens is that effectively locks the check into that particular account. And also a list is created noting all the checks that were received for the day. The cashier then forwards the checks to basically an organization, typically somebody in Treasury, that is going to create a deposit. And so the cashier forwards a check to the deposit function, and the account basically remittances go on to accounts receivable, and basically the cashiers are going to prepare 3 copies of our check listing. But what you can see here right now is you can see the checks, the physical checks, are going to the cashier. The cashier deposit function then is going to total the checks and reconcile to the remittance listing that comes along with those checks. And the cashier then will deposit the check or deposit the checks, and those checks should be deposited on a daily basis. D-A-I-L, well, it's a very D-A-I-L-Y, on a daily basis. And then the cashier then is going to post each check. the cash receipts register. Now here I do have an error, and this should be a debit to cash, a DB to cash, and the credit should be to accounts receivable. So that should be the journal entry right here. So that entry's incorrect. Now, a copy of the remittance advice that came off of the checkup here goes to accounts receivable, the accounts receivable department. Accounts receivable reconciles remittances to the cash remittance list. Remember, we made several copies of that list, and then post those remittances to the accounts receivable subsidiary ledger. Okay, now let's take a look at the next slide. And this is kind of a summary of internal controls over cash receipts. Okay, first thing is 2 clerks should be present in the mailroom during the opening and recording of the checks that are received. In other words, there shouldn't be 1 person there should be 2 people involved. Okay, checks should be restrictively endorsed upon opening the mail. In other words, lock the checks into the system. A remittance list should be prepared listing all checks received, and as we talked about, that remittance list is going to go on to the cashier and also to accounts receivable. All checks are deposited on a daily basis. The bank deposit slip that is created by Treasury is then compared to the daily remittance list to make sure that everything that was listed on the list has been deposited. There's a periodic reconciliation of the accounts receivable detail ledger to the accounts receivable control account to ensure all receipts posted to the subsidiary ledger agree to the total receipts posted. Again, as I mentioned in the previous slide, account statements are periodically sent to the customer so the customer can review and verify the transactions that have been posted to their customer accounts are correct. Now, there's something else that you may run into in the exam, and it's called a lockbox system. And very few companies do actually deposit checks the traditional manual way, where we have clerks sitting in the mailroom taking check receipts. More typically now, checks are sent in to an address, and that address is usually a bank address or a bank P.O. box for a bank address, and the checks automatically go to the bank on behalf of that company. That's what we call a lockbox. They're sent to the bank lockbox. So it's used when checks are sent directly to the bank instead of the employees at the company handling the checks. What happens is then the bank will obviously deposit the checks on that daily basis and will send a listing, in effect, or will send the remittances of those checks directly over to the company. So the company itself never has to handle the cash. It goes directly into the bank, and we don't have to worry about that being done. Okay, now the last area we're going to talk about, and this is called basically if we have cash sales where there's transactions are in simply cash, where you walk into a store and you pay cash for something. Okay, the first thing we have to understand is that cash sales under these circumstances may lack a proper segregation of duties, as the sales clerk, the person who's handling the cash sale, may, number one, they're in the position of authorizing the sale. In other words, they're taking the cash for the sale. Also, that salesperson is recording the sale typically. Either they're going to write out a cash receipt, or they're going to give you a ticket, or they're going to record it on a cash register or some type of sales terminal. Also, the sales clerk, and this is the toughest part, has custody over assets related to the sale. In other words, any point in time, the sales clerk has custody to the cash that is being paid, and also has custody of the inventory. So in effect, the sales clerk, because of the issue regarding segregation of duties, could basically take the cash from a customer and hand them the inventory without recording anything. That there's an excellent example of proper segregation of duties. Now, when we have cash issues where a person is in charge of all those functions, we have to try to increase the types of internal controls over the cash. And as an example, one of the things for cash, we should require the use of some form of a cash register or a sales terminal to record the transaction. Now, what that means is every time somebody makes a sale, the cash register should go ahead, we should record that sale in the cash register. I don't know if you've ever noticed, but you'll see very few products are, if are like, let's say, $12 a piece. They're going to be like $12.59 a piece. Now, some of that can be psychological. Well, $2.59 is sounds a lot cheaper than, or $12.59 sounds a lot cheaper than 13, which is true. But on the other hand, what they're trying to do is force the clerk to make change. And the only way the clerk can theoretically make change is by opening the cash drawer of the cash register or the sales recording register, whatever you want to call it. And so the customer is going to have to, the customer gives them $13, they're still going to have to come up with the change. If the customer gives them 20, they're going to have to open the cash drawer in order for the sale to go through. So if you want to know why a lot of products are given odd prices, traditionally that's been one of the reasons. Now, it is true that in effect, the sales clerk could open the cash drawer by pushing what they'll call like a no sale button, which automatically opens the cash drawer. In traditional systems, what will happen is that will ring a distinctive bell on the cash register, which alerts the supervisor to the fact that the cash drawer is being opened without the recording of a sale. And that's also the same thing on electronic type of transactions. It'll appear on a supervisor's terminal that the drawer has been opened without recording the sale, or there will be a buzzer or things like that. Uh, and obviously that goes with this next item in terms of cash sales, increasing observation. And that would be people who are supervisors who are nearby over the watching cashiers or cameras, etc. One of the places that I find completely fascinating regarding cash handling, the cash handling process, is in casinos. Obviously, casinos are a huge cash business. Chips are literally the same thing. And you would not, you may, I shouldn't say you would not believe, but you may believe how many cameras are actually watching every dealer and every cashier. And also, cashiers have to follow certain procedures, such as clapping their hands when they're leaving a table or starting a table, to show that they have nothing stuck in their hands or their palms or so forth. It's pretty fascinating. Another thing is customer audit of the transaction. In other words, you've probably seen, your food is free or this transaction is free if the clerk fails to give you a receipt. There's a good example of a customer audit of the transaction. Every customer should normally receive a receipt. Even you go to McDonald's, you get a receipt. And you do see at a lot of places your food is free if they don't give you a receipt. The reason for that is they want that transaction recorded. Another area is bonding of employees. In other words, companies will professionally bond or will insure against employee theft, which means the employees typically go through a form of background check in terms of their what they may have done in the past. Okay, with that, all that being said, then let's go ahead and look at some of the questions regarding internal controls over sales receivables and cash receipts. Number one, at which point in an ordinary sales transaction of a retailing business is a lack of specific authorization of least concern to the auditor when they're conducting an audit? You have your four choices. Stop the video. When you've reached your choice, go ahead and restart your video. Okay, let's take a look at number one, the answer. The answer to number one will be D, cash sales. And as it explains here, in a cash sale, the sale is automatically authorized by the salesperson. So a cash sale is a cash sale, and it need not have a specific authorization. Remember, we have the commingling in that previous slide. Okay, let's go on to question number two. During the consideration of a small business's internal control, the auditor discovered that the accounts receivable clerk approves credit memos and has access to cash. Which of the following controls would be most effective in offsetting this weakness? So again, you're given four separate choices. Go ahead, make the choice that you feel is appropriate. Also, remember to stop your video, and when you're ready, restart the video and go ahead then review the answer. Okay, in this case, the answer is C, and this involves increased supervision, which we've talked about. So during the consideration of a small business's internal controls, the auditor discovered that the accounts receivable clerk approves credit memos, has access to cash. Which of the following controls would be most effective in offsetting this weakness? And the answer again would be C, which is increased supervision, in that the owner reviews credit memos after they've been recorded. Because the accounts receivable clerk could take the cash forwarded to the company and issue a credit memo to reduce the customer's account balance. So the company would not be wiser, nor would the customer, since the customer's seeing in effect the equivalent of the payment on their account. So in reviewing every credit memo that is issued, the owner could ascertain the reason for the credit memo and determine whether or not that credit memo was actually justified. And this is also talking about the smaller a business is, the more involved the owner or the supervisor has to be. The less the internal controls, the more we have to be involved in the supervision process. Okay, let's try question number three. Which of the following controls most likely would be effective in offsetting the tendency of sales personnel to maximize sales volume at the expense of bad debt write-offs? So again, you have your four choices. Stop the video. When you're ready with your answer, restart the video and take a look at the answer to number three. Okay, the answer to number three. Which of the following controls most likely would be effective in offsetting the tendency of sales personnel to maximize sales volume at the expense of bad debts write-off? And the answer in this case would be C. Employees involved in the credit granting function are segregated from the sales function. And again, if sales personnel are authorized to approve credit for customers, they can increase their sales by simply selling to less creditworthy customers. And since they can go ahead and they can approve that, and they don't care about the write-offs. Okay, and the other areas, A, Denial of access to cash wouldn't prevent salesmen from bringing on new customers and granting them credit, because that has nothing to do, the credit has nothing to do with access to cash. The sale's already been made with B and D. Subsidiary accounts receivable records would still agree to the control account under the circumstances. So let's go on to number 4. Number 4, credit approval prior to shipping goods supports management's financial statement assertion of. Again, credit approval prior to shipping goods supports management's financial statement assertion of. And again, go ahead, stop the video, select the correct answer. When you're ready, restart your video. Okay, and the answer to number 4 is valuation. So basically, this internal control procedure helps establish the probability, in effect, that the company will receive the full value of its assets, because it is going through the credit granting process. Let's try number 5. To determine if internal control over a business-to-business company minimizes a failure to prepare sales invoices, the auditor most likely will most likely review. Now, do not worry about when it says over a B2B company. It doesn't even matter. It's just simply over control over a company. Minimizes a failure to prepare sales invoices. In other words, we're not preparing sales invoices based upon items that have been sent to the customer. So the question is, which of the 4 would be the most likely? Which of these 4 items would we most likely review? So again, stop the video, make your choice, and when you're ready, restart your video. Okay, the answer to number 5, the answer to determine if internal control over a B2B company or over a company minimizes a failure to prepare sales invoices, the auditor, in effect, will most likely review the shipping file, because the shipping file is going to be the file that generates the invoices. As I say here, shipments generate the sales invoices, and comparing all items shipped to all invoices produced should help identify shipments that were not billed. Okay, let's take a look at number 6. And with number 6, which of the following activities most likely would not be an effective internal control to reduce a risk of errors in the billing process? So again, take a look at your 4 possible answers, and when you've arrived at your correct answer, go ahead and restart the video, which I've assumed you've already stopped, and look for the answer or look at the solution for question number 6. Okay, number 6, which of the following activities most likely would not be an effective internal control to reduce the risk of errors in the billing process? In this case, it would be D. And again, let me get my marker out here. D, reconciling the control totals for sales invoices with the accounts receivable subsidiary ledger. Now, as I mentioned here, the AR subledger contains the continuing net accounts receivable balance of each customer's accounts receivable activities from when they begin. The sales invoice totals are only for the accounting period, so they would not be an effective control to basically reduce the risk of the errors in the billing process. Okay, let's try number 7. Which of the following would result in a misappropriation of cash going undetected if the same individual collects cash for credit sales, and again, stop your video, make your choice. When you're ready, restart the video and take a look at the solution to number 7. Okay, answer to number 7. Which of the following could result in a misappropriation of cash going undetected if an individual collects cash for credit sales and in this case the answer is A, records credit sales in the general ledger and post to the subsidiary accounts receivable records. So as I say down here, if the credit sale is never recorded in the general ledger or in the general ledger accounts receivable or the subsidiary ledger, it's going to be like if the sale was never even made. So under this circumstance, it would look like there would be no discrepancy. Up again, my marker didn't work. There's going to be no discrepancy then under those circumstances between the AR ledger and the AR subsidiary records. Okay, let's take a look at number 8. For proper internal control, when customer checks are received in the mailroom, a copy of the remittance listing should be sent to, and again you have your 4 choices: stop the video, ascertain what you believe to be the correct answer, restart your video, and review your answer slide. Okay, the answer for number 8. For proper internal control, when customer checks are received in the mailroom, a copy of the remittance listing should be sent to, and the answer in this case would be A, accounts receivable, to update accounts receivable subsidiary records. Okay, let's take a look now at number 9. And number 9 is basically, which of the following controls would prevent the misappropriation of cash by employees? And you're given your 4 choices. Stop your video, make your choice for the correct selection. When you're ready, restart your video. Okay, number 9. Which of the following controls would prevent the misappropriation of cash by employees? And this is an excellent example when we're talking about a lockbox. In this case, this would basically prevent misappropriation of cash because a bank lockbox system, in effect, the checks are sent directly to the bank itself, and the employees never have access to the cash in this case. Okay, let's try the last question, which is question number 10. Number 10, an online sales order system has the following advantage over batch processing. Now again, this one, we haven't talked about this, but I think it should be pretty intuitive. So again, an online sales order system has the following advantage over a batch processing system. You're given 4 potential advantages, and when you're ready, go ahead and stop the video, select the correct one. When you're ready, go ahead and restart. Okay, and the answer to number 10, an online sales order system has the following advantage over a batch processing system, and it is simply, we would be processing sales information immediately, and that's the answer to number 10. So that's all the multiple choice questions for internal controls. So that is the end of our video presentation. Thank you for your time.